All right, we are live for another Ask Me Anything happy hour. Welcome, everybody. As people start to come in, I just want all of you to know one very important thing. We were talking offline before we started this. Aliens are real. So make sure you get your questions ready. We'll be right back after this. All right, folks, as we get ready to do this Ask Me Anything happy hour, we've got some really interesting stuff coming on and happening because we just got back from Money Tank, which was the private money club event out in Raleigh, North Carolina. And not only that, we got all sorts of new events coming up. Hannah, you guys got a training coming up. Can you just give the audience a quick snapshot of what you guys are doing here?
Absolutely. So on August 22nd, 6 o'clock Eastern time, Brent Kessler, who's my father, him and myself are going to be going live on a free 3-hour live training. So that's the 22nd of this month, 6 o'clock Eastern time. And we're going to be going through some advanced topics on the infinite banking concept. So come join us, especially for you folks who are maybe already doing this and you have other people that you want to turn on to this concept or you want them to see this powerful information. This is the webinar for those people. So come join us. It's a free event.
Awesome. All right, Gabby. Well, we got a lot of questions that just rolled in. It was pretty cool to see that all from this afternoon at Wealth Webinar. But want to start with the pre-submitted?
Yeah. So we have Emily. I tried to post this one, but it's too long, so I kind of broke it up in a million different pieces that are not all in order. So I'll just read it to the best that I can, and then we'll just break it down. She's got three-part question, so I'll start with her backstory. She says, her life passion is for alternative education, helping families start learning communities for their own kids in their own towns. She has all the tools, the processes, and trainings available for families to succeed, but has yet to implement the system because often the communities struggle with financial security. She's imagining IBC solving this problem, with each community being founded as its own bank in order to recapture and reuse all those tuition funds that come in. So the first question she has is, how would this slow down the creation of the communities with only 50% plus of the funds available in the first years?
50%? Where are you getting your numbers? Like it's going to be
more
than 50%.
Actually, I like 50%. I like to under promise and over deliver. So it's going to be better in real life, but I'll tell you it's 50%. I like that number.
Yeah. All right. So, I think you're way low on the percentage, but hey, we'll kind of, look at the low numbers. So one of the things you'd have to factor in is the fact that you're not going to have 100% of your money available immediately. When you put the money in, it's not going to just be 50%, but, let's just pretend that it was. We'd have to basically build that into the community's growth and figure out how the future growth will outperform the today growth, if you will. So that's the first thing. But again, I'm having a hard time just thinking 50% because I'm like, I know for a fact it's not 50%, not even close. It's way more than that. So does anyone else want to hit on that first one?
Well, here's my feedback. So I always talk about that there's no silver bullet out there. And so policy designs can be designed any which way. You can have access anywhere from 0% all the way up to 90% of your cash value, just really depending on how that policy is built and designed. And so that's why you have all of our lovely faces posted up on the screen, because that's where we come into play, is that it's really taking your needs and your goals and incorporating them into that best policy and strategy that you're doing right now.
And Hannah, would the mapping team be able to help with like if they knew how much the tuition costs and like all the things and kind of like map out how to repay all of that? Because I feel like the only other issue would be there's a level of discipline that has to come in as far as repaying that tuition, especially if I don't know if it's the way it sounded like it was more of like grade school, like kindergarten through high school. And so that's a lot of years, which is great. It's a good use of a bank over and over to recapture. You just have to have like a level of discipline to make those recapture payments.
That's it.
Yeah.
Go ahead, Jason.
I was going to say, I was more curious about just the context of the story, right? Like I love the passion of helping, educating families, communities. building this into the, into the community as a foundational principle, right? So I think that's super exciting. I'd love to know more context of what she's talking about with you reuse all the tuition. What tuition? What are we talking about? Like, what does that look like? Like Hannah's saying, it's really going to depend on the problem in front of us. Like, we can solve the problem if we know what it is, but we need to know what that problem is. And then if we show you what the problem is, and we can teach you how to think long term. Like, if you're trying to solve for communities, then waiting a year, 2 years is not a problem. Like, that first question is not a problem if you're really doing it for the long term and not just for year one, right? And no one's going to talk about Hannah being in the woods down by in a van down by the river either. Come on now, we missed this.
Y'all missed it. I got a shower today.
We didn't go around and do the intros just because I saw a million questions come in, so I wanted to save time today.
Yeah. But that almost reminds me of like Vivi Lucky Jeans a little bit, like Chris, like how like, you start using it for whatever it is that you want, and then eventually it can turn into, her college tuition, then like a down payment on a house and stuff like that. So it does seem like a good concept. It just has to be like really thought through. I'm sure Craig's nodding his head because he knows a lot about the long game.
He has spreadsheets for all this, for long game stuff. So
short term, long term, spreadsheets do everything. So
aliens love spreadsheets. That's what we talked about too before the show came live.
Yeah, you can't tell anybody who the aliens are on our team. Otherwise, people get strange concerns here. But I'm glad Carson joined, because now we got the Brady Bunch layout again.
Look at that.
He was too busy.
Big group, guys.
Big case.
And anybody else know that Carson's giant? He's 6'4", someone told me. I did not know that. So that's exciting too. Just fun facts.
Throw it out there. We got a fun group today. Hannah, where are you calling from? Where are you at?
I'm in Black Mountain, North Carolina.
That's awesome.
What, you want to see? There's the beauty. There she is.
Wow.
There we go. Hey, but real quick on this question though, because actually I'm working with somebody right now where he's a member, he's got policies, and he is putting the policies on his 2 younger children right now, and his children do go to private school, and so the tuition is $10,000 a year, and so what he's doing is he's starting the policy for each of them $10,000 a year into the policy, and yes, year 1 he's not going to have access to the full $10,000. So when he puts in $10,000 the first year, he's going to have access to about $6,000 year 1. So, but he's okay with it because he does have the other active income that's coming in to him. So he says, okay, it's okay that I don't have all of it. I'm going to use all that I can from the policy, and then I'll outsource the other funds from my active income that's coming in because I have the cash flow to do so. And then when it evolves, hey, I'm going to get to the point where the full tuition bill can get paid directly from the policy. And then essentially what he does is over the course of this year, he just saves back up inside of his policy, prepping for that next tuition bill that's going to get paid.
Whether it's for private school or not too, this is something we should dig into another time. I don't want to waste too much of asking anything on just this one question, but that's how much I think even just daycare is for some people. Like I have a friend who has 2 kids, and they only go like 3 days a week, and their like daycare thing is like $1,000 a month, which ends up being like $12,000 a year. So this is an interesting amount to start for your kid, whether they are going to a private school, whether they're just going into some sort of daycare. It's an interesting amount.
So Emily is on now, and so I posted what the tuition range is, and she also said maybe we could give the students discounted tuitions in their first years.
Yeah, that'd be a great idea.
So that is a great idea. Okay, I'll move on to her second question. She says, how would the person being insured work? I imagine it would be each student, but what if that student leaves the school? Or what happens when they graduate? Where does that death benefit go eventually?
You keep it. You're the owner of the contract. Whoever's the owner of the contract keeps that policy. All right, sorry, I got excited.
Yeah, that's an easy one. Yeah, that money goes with the owner.
So like
Okay.
even still to this day, dad owns policies on associate docs in his clinics and his past employees that don't work for him any longer, but he owns the contract. One who has the gold makes the rules. So he's still using those policies throughout his life right now.
Okay, and her third question is it possible to structure the banks or the community so that each family gets some sort of benefit or practice using IBC themselves while they are within the community?
That's how I kind of read the first thing, was almost like kind of convincing these people to have their own policy on their own child, like me, like with my daughter, and I would send my daughter to this school, and then eventually that policy would work for the rest of her life and our life, and what a value that would be to attend a school that essentially set us up for the rest of our lives. So to me, I guess I'll just leave it at that. That's the thought that my mind was going in the beginning.
No, that's pretty cool to make it a benefit to the students, right? To make it a benefit. I think of it more as like employee benefits, just because I've been focusing on that a little bit more than like students. So like I'll kind of give this example, but then put it into the student world. So like, hey, Mr. Employee, let me open up this policy on your body. And hey, you want health insurance? You want dental insurance? Absolutely. I'll fund that. I'll use the cash value in the policies to fund those benefits for you. Or hey, instead of opening a 401k account, you're going to use your policy, put money in there, and later on in life, you're going to use this policy for the passive retirement years. Just so many different things, because you can literally use the cash value in these policies for literally anything. So how do you want to use them? What are the benefits that you want to offer to those people?
Yeah, and one of the things I'm thinking about in this whole process is you've got the three players, right? You've got the owner, the insured, the beneficiary. So if your kids are going to the school, is the school the owner of all these policies and the kids are the insured and school's beneficiary? I mean, how is this whole thing getting laid out? I'm not quite clear on this plan just yet.
Yeah, so I guess the main idea, Emily, is that it definitely can work. And actually, I think eventually it'd be a cool case study. But we just got to figure out more minor details in the meantime. She's in the period where she's afraid she's too new to the concept to wrap her hand around the ideas in this unique way. So, but her main goal is self-directed education to allow families and children to develop freedom, adding a practice in financial freedom. So this can definitely help.
That was literally the first thought I had after reading Becoming Your Own Banker a couple of years ago, right? Was, why doesn't every American know about this? Like literally freaked out. Like I got super angry about it. I wanted to sell everything I owned and, divorce the banks immediately. And then, so the fact that we're all doing this to free people from, financial, we'll call it financial slavery, right? That's what Brent says all the time. So what Emily is doing is just bringing it to an educational level. And I mean, it's no different than buying a car, a boat, anything else through a policy. Within a couple of years, you're actually making money by sending your kids to school, right? Because once your policy hits that efficiency point, like by the time they go to college, if they're in grade school or middle school, then the 30, 40, 50, whatever thousands of dollars you have in there can pay for the tuition. Then you put it in every year and you're actually making money on them going to college. So yeah, huge benefit if people start really learning the power of this, right? So Emily, just the fact that you're exploring this is super exciting. Okay, I have the next person is Gavin, and I'm hearing Hannah and Brent in my head already, so I know what she's gonna say already. So okay, here we go. I'm not a fan of locking my money up, but what are your thoughts on contributing to a company's 401k just for the match?
I mean,
I'll tell you what I did.
Oh yeah, I mean, I'm going to definitely differ from probably everybody, but go ahead, Craig.
I mean, it kind of comes down to your own strategy and solution. But when I started doing policies 15 years ago, it'll be 15 years in October, it was in place of the 401k. I said, I'm not going to do this 401k thing anymore. It just isn't working out. I'm not seeing how it's going to be a long-term benefit for me. So I started asking myself questions. Do I think tax are going up or down? Well, Craig, I think they're going up. Can I get access to this money? Can I use it during my lifetime the way I want to? No. So for me, I just quit funding 401ks. I'm not a fan of them, but some people love them. If you want to get them for the match, I know some people like to do that, but I just wholeheartedly just abandoned the whole program. So for me, that's what I did.
It's so great, Craig, that you did that by the power of questioning yourself. Like, so many people are missing that superpower of asking ourselves better questions. I would just get frustrated and leave and go back to my life. Be like, F you, Mr. Schwab. Like, I don't understand what you mean by taking on more risk or retiring 20 years later. I'm just going to go out and it all sounds like peanuts, teachers going womp to me, right? But I did not do what Craig did 15 years ago to make what he's doing today, right? Having his money work for him. His little green men are out there. And Craig, how much are you making in your 14-year-old policy for every dollar you put into it?
Somewhere in the neighborhood of about $6.50. So it's one of those older ones. I tell you, you let them sit for a while, they sure look nice.
Sure do. All right. I'll
Drew's comment when. Pardon, I just said I like that you posted up Drew's comment. Drew's comment is what I would say.
I think Drew's comment's really good. He just took what he would put into the 401k and put it into the policy. But let me put my compliance hat on. Hold on. So I always talk about 401ks in a maybe different light than what you're hearing here. And I think there's a couple factors. Number one, I think, anybody that has access to a 401k, if they're working at a job that they think they're going to be at that job for 5 years or longer, they don't think there's going to be a break. They're not going to leave. They're not going to get fired or laid off. I know you can't predict that, but just anticipation of staying there 5 years or longer, then I would say yes, put in up to the match. But just be aware of the vesting schedule that the company has, which is always going to be a period of time before you're vested to even take the money that they give you in match. And those vesting schedules can go anywhere from 3 years. I've seen 10-year flip vestings. So you really got to look first before answering that question, look at the vesting schedule and ask yourself, am I going to be at this company longer than that? And if the answer is yes, then sure, put in up to the match and not a penny freaking more. If I had Shauna's hat, I would have put that on because that would have been more suitable.
That looks like more of a compliance hat than a backwards baseball hat. So
could have made it a rally hat. I thought of that too. Just flip it inside out.
I had an insurance agent. I was talking to Christy today, and an insurance agent was telling her, "Oh, you mean the guy in the baseball hat?" And like he was saying that in a negative thing. And I'm like, dude, for 16 years, I wore suits. Designer suits. I still have them all. I can't even imagine how many tens of thousands of dollars in suits I own. And I feel like I've earned the right financially, mentally, and just confidence wise to not have to put a suit on to get people to want to do business with me because I look a certain way. People that want to do business with me want to do business because I'm telling them the truth, giving them sound advice and showing them the right path, not because I'm wearing a baseball hat instead of a suit. Those are the people I don't want to work with. And Jason, what do we always say? We must first know who our client is not so we can know who our client is.
1,000,000%. 1,000,000%.
I think that the way you look starts to shake up what people think about money in the first place, which is what we're trying to do. So, you don't have to wear the suit and tie and be super professional and stuffy and all the time to know your stuff. So before we get too far, Emily did ask this one follow-up question. I just wanted to get to this before we moved on too much. Is there anyone I can chat with to flesh out these ideas when we're still in the concept phase?
Heck yeah.
Your mentor.
Yeah. Who do you want to speak to? I mean, you got 1, 2, 3, 4, 5, 6, 7, 8. Throw a dart at the screen.
I'm pretty sure. Well, Chris, I'm pretty sure Emily and I want to say it's her husband. I think too. I could be wrong here, but I think they're in underwriting right now. Okay. So I would reach out to your mentor of who you chatted with on the forefront.
And Emily, that like everybody on here, like you don't need to pick somebody. If you're already in underwriting, you've already been working with a mentor, like that mentor is already talking with all of us anyway. So you pretty much get all of us just by talking to the person you're dealing with. So whoever you pose the question to, like they'll give you their opinion and they'll probably bounce it off us. We have like this group text that is going nuts every single day, 24/7. And it's basically just us discussing these different things, that clients have questions about that maybe one person might not have expertise in, but another person on the team does. So you get a whole team approach. So don't think there's one particular person you need to talk to. You're talking to all of us.
And Chris, it's okay. I talk to people about money, and I live in my van down by the river.
And how much was that van? Sorry.
Well done.
Can we take one comedic little break? I got a 60-second video teed up. Are you good for it?
I actually know exactly
Please
what
play
you're
Chris
talking
Farley.
about.
The river.
We got 60
Please
seconds.
play Chris
here.
Farley.
Ready?
I miss him.
Here we go.
All right, how's everybody? Good. Now, as your father probably told you, my name is Matt Foley, and I am a motivational speaker. Now, let's get started by letting me give you a little bit of a scenario of what my life is all about. First off, I am 35 years old. I am divorced, and I live in a van down by the river.
All right.
Why does he sound like you?
Something that tied back to a van down by the river.
Anna.
Oh, that was good.
Thank you, Snaggy.
You're welcome. Don't let Cash see in my cup either today. Ruff, ruff.
He doesn't care. He doesn't have
He
time.
probably barks.
He doesn't have time to be bothered by things like dog business. That's below him, Stephen. That's far, far below Lazy Cash.
Janet, we got to meet Janet and her daughter at Money Tank this week.
Yeah.
What's up, Janet? Hey, Tess. All right, I'm just popping in to say hi. Go ahead.
Okay, so Matt's asking about the program earlier today with Suleiman. He had to leave early and was wondering how to rewatch the program.
Yeah. So, there's no recording of it because we can't record those ones. It's not allowed. Just he doesn't want somebody stealing it. So if somebody in the chat can put this, Matt, we're going to put an email. You just email support at the Wealth Builders Group, wealthbuildersgroup.com. So support at the wealthbuildersgroup.com, and just give your name, your phone number, and then obviously the email will be in the email. And then just tell them you want to jump on the next webinar. And they do a webinar every month.
Jason and I were actually talking about them today. And I don't know if this is public knowledge or something we can share, but we were talking about getting the mini tax structure he has set up. Are you guys familiar with it?
Yeah, he just presented that today for the first time in our group. It's awesome.
Yeah. So Jason and I were talking about doing that ourselves. What's the kind of the criteria to start doing that?
Gosh, it's significantly lower. I think this is very loose, but if you're making let me just tell you, you both qualify. Is that good enough? I already know what you make. That's good. You both qualify. Okay.
So I was sharing with Carson. I mean, this is probably a whole nother subject for another day, but I talked to a CPA who's very familiar with trust structures, has one himself. He's taken like 30 companies from startup to selling for multiple hundreds of millions of dollars. Right. And his suggestion to me was like, listen, you could use the trust structure. I'm pretty certain that that's going to work for you where you're at. But the way that you're structured right now, you have some other things to do with the business as far as getting your business LLC licensed in all states, getting that to be contracted first. You want to create a couple layers of separation rather than have the trust be the, catch all. So that's what I was sharing with Carson is it might be premature depending on how we're structured as a business too.
It'd be worth you getting on a call and just doing an analysis, because remember, it's not just the trust structure that he's talking about. It's also operating companies, which are entities, so LLCs and things like that. So you could have, I don't even know how many I have, but I have a bunch of entities, and then they all flow into the trust system. So that's all part of the thing. I just get on a call with them. Can't hurt.
We'll do it. So it's support at the wealthbuildersgroup.com, correct?
Yeah. Mm-hmm.
Hannah, I got a couple questions coming through for you. One's from Eve. She's asking if they'll be getting email invites for your training.
Yeah. Hey, and actually, I put it in that private chat that we have over here. Can you post that link in the live chat?
Sure.
So the registration page is live. And y'all, you can always go to our website, themoneymultiplier.com/events, with an S at the end, events. And you can see all of the events that we're speaking at around the area. Because actually next month, I'm going to be in Phoenix, Gary, Indiana. In October, we got Jacksonville, Fort Lauderdale. So there's a lot of live events coming up. I know, Noggle, you're going up to Langhorne, Pennsylvania here next week.
Yeah, me and Joe.
Or that's this week. That's this Saturday.
Yeah, we leave Friday for
Yep.
a client's charity event, and then from there we stay over and we drive super early to Larry's, and I speak there.
Yeah.
Okay, Hannah,
But
here's
like
your
emails and
Sorry,
Oh,
I
go
didn't
ahead.
interrupt you.
Sorry.
Here's your other one. Drew asked this last week too. He's asking if your channel got.
Drew, I'm working on it.
It's not very hard.
I saw Drew this weekend.
Hold on, I got one more before we go any further. How many of you on here that were at the Money Tank have always wondered who FCAT 420 was? He's on every single training we do. We finally got to put the face to the notorious, famous webinar name, FCAT 420. Good to see you, buddy.
There
What's
he
his
is.
real name?
Felix.
Felix.
Okay.
He was on the
Felix.
webinar too. He was on there and in full charge.
Now we can
He's-
call you
he-
Felix instead of FCAT.
He drives truck. He works 18-hour days. Right. Always listening. He hasn't listened to the radio in 2 years because all he listens to is our YouTube videos, podcasts, all sorts of stuff.
I'm gonna have
Man.
to go to the lounge for some cocktails next time he's up in the New York area. He's there quite a bit.
I feel like Felix and Dexter might be fast friends.
Oh, seriously. Immediate friends.
Yeah.
Like the movie Step Brothers. Did we just become there's so much room for activities? Anyway, Devin does that way better.
And Felix, Fix It Felix is my favorite arcade game. So you have a special place in my heart.
Love it.
Okay, Janet. Okay, she says in the employee example, could both the company and the employee have policies?
So the company can. Yeah, they could. The employees just have to be insurable interest by the company. That's all. If the company's paying for them, that is.
So if the person tries to get their own insurance in the future, are they held up by what the company has on them?
Well, I mean, it's all going to play into the human life value that the insurance company calculates, but it's not going to hurt them bad. I mean, so if the company does 500,000, and pays for 500,000 worth of death benefit, take 500 off the total insurability of the person, and so it would count against the employee a little bit. But that's why the company can't just own the policy on the employee without giving them an insurable interest. So what that means, like I always talk about with banks, if the company owns the policy, the employee has to be given some equitable, exchange. And usually that's a fully paid up death benefit. So if it's a $500,000 death benefit, maybe the employee gets $50,000 free, fully paid up. And that then is an exchange for that.
Mm-hmm.
I've had companies that own the policy give 100% of the death benefit to the employee. Now it's rare, but I did have one company I did it for. They were interested in only the cash value as a way to move their money for equipment purchases in their company.
Okay, Hannah, I know you're talking. Emily chimed in again. She just said she hasn't been connected with a mentor yet because they're waiting on their physicals to get done. So if you want to, I don't know if there's some clarity that needs to happen.
Everybody, I got to do one thing real quick.
Oh,
Hannah, you're muted.
Hannah, you're muted. But if she's getting her physicals and stuff done, then she had to have already talked to somebody to even get in the process. Gotcha, Hannah.
That's what I was thinking. Yeah. So Brent and Jay Andros. So you probably spoke with my father on the forefront. So reach out to Brent. All right, you ready? I'll grab a pen and a paper. I'll give you a cell phone number right now. 785-248-9637. Text him, call him.
And it's really his cell phone, and he really answers, and people always freak out that they're like, how he puts it on the website. Like, how can he do that? It's really Brent. It's pretty cool.
Or email too, Brent, BRENT at themoneymultiplier.com. And I think Pops would be a good person to talk to, because in my opinion, I think it's kind of the same thing like how Pops used to do it with the Cairo clinics and the employees and the CAs and the docs in the office. And then now it's just within the school world, education world, I should say.
And then when you guys figure it all out, our whole team wants to know how you did it.
Yes. I
Yeah,
even wrote a
case
note
study.
to ask Chris about the company-owned death benefit, that again, because that is a question that comes up that I could definitely become more informed on. So.
Okay, we'll move to one. He says, when you say to borrow money from yourself and you pay interest on that, if you have a loan already with 5% to a car loan, when you pay yourself at 7%, that means you will pay more?
So there's a couple ways you could look at it.
half-listening.
Like if you're just recapturing, say it's 550 and that includes the 5%, like that's what we're saying, that you're already paying that. We don't want you to change anything. So you're just paying that back to your segregated. If you decide that, hey, the rate should be a little higher and you want to pay yourself at a higher rate back into the segregated account, you can do that. And we design these pretty efficiently. So you may or may not have enough room to put additional monies back into your policy, or that might be just a storing in your segregated until you have more that you need to warehouse later to open a second policy. I don't think I was as clear as I wanted, so please jump in, Hannah. I see you jumping through the screen.
Well, no. That was perfect. I say, well, here's the thing. Nelson Nash's book is called Becoming Your Own Banker. You are your own banker now. What interest do you want to charge yourself? I tell you, my interest that the Bank of Hannah does, I do 10% interest back to myself, because just the more aggressive I am on the interest, more money back inside my pockets anyways. So you follow the prime rates of what the markets are doing, be more aggressive, or heck, don't pay yourself back. Don't pay yourself back with interest at all. It's really, the choice is yours and how you want to use the policy. But hopefully we're good coaches and that you are playing honest banker within your lifetime. I don't know. Does anyone else want to add?
Everyone talk at once. Not everyone.
Yeah, I think we hit it. It's just a matter of whatever you were going to do to somebody else's system, do to your own. It's just, if you were going to pay the dealership $500 a month for the next 5 years, do the same thing to your own system. And as you're doing that, you're going to put that back into your policy loan once it's paid back, as Jason was mentioning. Do you have room in your premium? If not, we're going to set that thing aside for premiums for next year. So really, it's just simple as thinking about whatever you're going to do to somebody else's banking system, do your own. So just take that same amount of money and put it in your own pocket.
Love it. Okay. I wanted to thank Eve here because she's always plugging our stuff that's going on. And I believe Shauna corrected to 5 tickets. But yeah, if anybody wants to jump in, there's Shauna has it right on hand.
Who's all going? Are you guys all going?
Yep. Yeah.
Yeah, I just got my newsletter in the mail today. 5 tickets. Why am I here alone?
They wanted you to put the QR code up so they could scan it. There you go. QR code.
Slide it the other way. There you go. Stay
Hold
still.
it there. Perfect.
Shauna,
now
stop
people
me.
could scan.
Perfect.
Doing a great job, Shauna.
All right. Now let's hear your monologue.
No.
Let's see some of the Chris art.
He's like, take me out.
Hey.
I'll just start going like this. Hey, your own bank.
We got puppet Chris going when you're gone, Noggle. So
I don't even know what was going on there. Okay.
No, we're saying 5
We're
money
all
take
giving you
tickets.
different voices.
Or, not money take. 5 experience tickets left, and then we had this out, the newsletter.
Nice. Not many. It's going to go quick. A
Yeah,
lot
it's
of
gonna be a
people
fun
that
one.
wish they would have acted quicker.
And it's our favorite event because we actually never have to spend a single penny on ad spend to get it sold.
Well, I mean, we've been doing it so many times. People that have come got so much value in the relationship. I mean, like, just think of the people that are there. All of those people, for the most part, are all doing business with one another or building relationships with that individual group. I mean, it's just like a power group.
Yeah.
It's very tight knit. It's very close, like a family reunion. We call it twice a year.
Actually, I had this thought today though too. If we do reach the limit at the past those 5 tickets, I think we can maybe talk about like maybe a different type of ticket, but like without some of the excursions and stuff, because those are really limited, but like more of, because Vegas has a lot more space, so it's just that you
more people. We the race cars, we wouldn't be able to do any more for that. But the other excursion, I think we could.
Yeah. We'll see. I definitely we're going to work on those first 5 tickets, obviously. And then we'll see about doing like kind of like a second tier option, which we've never done before, but we'll keep you guys in the loop.
Can we talk about like whoever wins this race car thing, what the prize is going to be? Because I'm going to put a little competition on the line.
Yeah, it's time.
No. We don't even need to discuss that because I would win.
Oh.
But the problem is the guy that's in the car with you, just so you know, has a brake. And every time he hits the freaking brake, otherwise they're like, you're not beating me.
Well, we'll see how big the prize is. I'm going to slide him a little bit of money. Don't touch that brake. Always a solution.
Oh, I love it.
No day drinking on that day, Stephen.
No, Josh can win the little go-karts. We're talking about some real race cars now.
Okay, Juan's asking, is there a way to transfer my 401k into a life insurance policy?
Not without paying taxes. And if you're not 59 and a half, you'll get hit with a 10% IRS penalty in a traditional 401k. I mean, if it's a Roth, it's a little easier because you just have the 10%, but there's no way to get out unscathed. I mean, the government has it set up pretty much so that you have no control of the money until 59 and a half, and then you still got to pay tax on it. So the tax part's not a big issue because you're always going to pay tax, but it's that 10% IRS penalty that you got to look at. And I always just tell people, I say, if you took your money out of the 401k and the only missing piece was that 10%, then the justification would be how quick can you make that 10% back? I just did the math for a client the other day, and it was less than 1 year lending through Private Money Club. So that's the decision you have to make and that you have to pencil out to make sure mathematically it makes sense and that it doesn't bump you into a higher tax bracket.
On that note, I just wanted to address this real quick. So Eve said she took out a loan from her retirement account as a lump sum dump into a whole life insurance policy.
That's super smart. And I remember Eve doing that, and I remember commending her then, and I'll do it again. But I mean, think about that. When you take a loan from the 401k, especially right now, you're getting your money out of the market, which means you're selling high, and the money comes out of the market and puts it into the whole life. Now, from the whole life, I can't remember what Eve did with it, but let's just say she paid off debts at 20%. I'm just hypothetically putting that there, and takes the amount she was paying to the debts at 20% and pays it back to her 401k or back to the policy, whichever way it goes. I would go back to the 401k. Now she's used money that she used to give away, and that money comes back to the 401k, but the interest charged on the loan from the 401k also goes into her 401k. So if we were doing the math of 20% on credit card debts, because that's, Stephen looked it up, that's the average right now, 20% that you recaptured to your 401k, that's like making 20% return, plus Eve would get the 6 or whatever percent they charged on the loan. So that's like making 26% risk-free. Yep. Thank Eve later.
Or thank her now.
Or thank her now.
Okay, I wanted to address Kimberly, her comment as well, because I feel like there's another workaround here. She said she has a trust that pairs nicely with whole life, but sadly she got turned down by underwriting because of her medical history, despite it being self-limited.
I mean, does Kimberly have children or a spouse that maybe we could look at doing the policy on, and Kim could own it? Because remember, with the ownership of the trust, it's just the owner of the policy, not the insured of the policy. So if Kim owned a policy on her husband, now since Kim has been denied, she automatically can do policies on her kids, but because now she's been denied, we have that in writing. Or a spouse, I mean, then you just own the policy and have the trust own it that way.
Same conversation I had earlier today with Nathan.
kind of like, wine, well, this wine pairs nicely with this.
Mhm. That's what I would say. Hey, y'all, I gotta go. I gotta go do an Instagram live for an event coming up in September. So Fort Lauderdale, 10/7. If you're in South Florida, Brent and I will come down there and we'll come see you at the South Florida RIA. So hit us up. We'll see you then.
Have
Also,
fun
you should
down by
climb
the
a
river.
tree to do it. Climb a tree to do the live. Do it from a tree.
I will.
That'll be awesome. I hope she's okay. Maybe she can't climb.
Yeah, now somebody's got to rush to the hospital. Juan says, on the videos when Chris says to put money in your policy, is that the only way you can, is that only what you put on your savings account, or can it be the whole paycheck and you loan yourself the money to pay off your normal debts?
Oh, I think somebody actually said this. Chris made a video on that. Yes, do not use it to pay your bills. But yes, I always say savings because the insurance company won't allow you to put 100% of your paycheck in. Well, I shouldn't say that. The insurance company won't allow you to put 100% of your income into the policy. Maybe your paycheck isn't all of your income. But you never want to put money in the policy and immediately take it out to pay bills, because think about it, your money's not working for you. It's just paying bills. So you're only making money one time. And what I teach, and I think what this whole team teaches, is how to make money twice, how to actually take your money and make your money go to work for you. So I like to think that a better strategy, Juan, would be put in the max amount that you would want, based on savings and income. I mean, however you want to do that. Don't put it all in. Make sure you keep enough out to pay your groceries, your utilities, your rent or mortgage and things like that. Take the difference, put it into the policy, then take the money out of the policy, and let's just say you lend it out at 12%, right? I'm just hypothetically saying that. You lend it out at 12%. Take the 12% and use that to pay your utility bill, your grocery bill, your college tuition bill, and all that stuff. Now your money's working for you twice, and now your money working for you is taking care of your home expenses. It's a much better way to do it. Great question, Juan.
Yeah, and Chris, I think I would add too, because there are some folks that don't have enough to do private lending yet. So don't look at it as a bad thing to just capitalize your policy. So even if you spent the next year capitalizing your policy so that you could do private lending, it's not a bad thing. It's just you got to get up to that level where you have enough to do that, to play that game.
And Eve, thank you for your constant genius in the chat, right? She's giving Juan some good advice too, where we talk about all the time, we all have to be in two businesses, right? The first business is a business of making money, right? So if we're not saving, paying ourselves first value money, our job is to go out. Chris says this all the time. I'm sorry, go find a way to make more money, add more value to the world, do more things, right? Figure out where you can add more value to people to make more money. And then the second part is, once you learn that, that's when you're ready to have the conversation of how to become your own banker. Like, how do I now make my money work in two places?
I agree with Eve, and I hear that a lot, and that's why I did a YouTube video about paying the expenses, because in Nelson Nash's book, he talks about that. But what people often love to miss in Nelson's book is that he said that works after like the 10th year. So we're not at the 10th year when we're just starting. Therefore, I always just try to set the precedents that don't do that. Now, by the time you get to the 10th year, as Craig could certainly tell you, and you put $1 in and take $5 out, I don't think anyone's going to care that you're paying your expenses from the policy. Then it really doesn't make sense. But in the beginning, it's a negative draw, and it really slows your whole process down.
I think for like the mindset too, for the real estate between our ears, it slows you down because it doesn't make you expansive enough. You're not thinking multifaceted. You're playing defense still. Like if you're just paying your expenses and things, like
you're going
from a mental perspective.
Right?
What's that?
The Jedi is taking over and messing up your signal.
Okay, I'm back. Should be good. Look, I moved Darth Vader. Maybe it was him. So he is now moved because of Chris last week. He slid over.
Okay, this is a fun question, I think, because football season is coming up. But he says, can you explain the compensation package that college coaches Dable Sweeney and Jim Harbaugh signed into receiving whole life policies as compensation?
Oh, gosh, yeah. Does anyone else want to do this one? I mean,
I haven't heard of it, so it would be really cool to tap into that. That's a great tagline, whatever that is.
Yeah. So I mean, basically, what they did is they instead of putting the money directly in his pocket, they put the money into whole life, and then that was his bonus packages. I mean, there's more to it, but essentially, what they understood is they understood the power of life insurance. Plus, for the team, by putting the money in the policy, they got the death benefit. So we always go back to like, hey, the death benefit matters. So the team knew that if something happened to Jim or Dabo, like they knew they were getting their money back, right? Because if something happened and they died, Jim and Dabo would get, their family would be taken care of, but also the school or the team would get all the money back. But because of the uninterrupted compound interest, by putting it into the policies, it provided that tailwind of interest behind the money. So they ended up actually getting a raise by doing it that way. They ended up getting more money by running it through the policies. It's everything that we teach every single day, just used in a corporate setting or, in a sports setting like this. It's pretty common now. So back then it was pretty revolutionary, but nowadays, like, this is a very common thing. They just don't call it life insurance. Why? Because life insurance has a bad name. So a lot of times they'll call it, a deferred compensation plan, or they'll call it something else, but it's all funded by whole life insurance.
I'm Googling it right
There's
now.
way more to it than that. So
you can see right here. So this was this year. He earned $10 million in 2022, and you can see the so an annual $1 million deferred payment from the university into the retirement plan, which is a whole life. There's another article that talks about the whole life and just shows how they're just dumping that in. And then down here it talks about if he was to leave, the buyout figure just changes a little bit. So it's one of those things that kind of keeps them there, which we do with executive plans all the time. I could pull up some other stuff. Just give you the basics of it.
It's really great if you really like wrap your head around that whole concept. I mean, both from not, I'm just going to pick on Jim now, but for Jim and also for the school funding it, like it's a freaking slam dunk for the both of them. It's a slam dunk from a tax standpoint. It's a slam dunk from a legacy standpoint. It's a slam dunk from a stickiness or a golden handcuffs for keeping Jim and Dabo there. I mean, gosh, I can't think of anything negative about it.
Here we go. Here's from ESPN. Let me just share this last one.
And Drew asked a good question too. Does he pay taxes on the premium?
That's a good question. Depends on whether the school is taking a tax deduction on the money going into it. My guess is yes, they probably are.
This one's from 2016. 2016, Michigan football head coach Jim Harbaugh agreed to a contract amendment that will increase total payments from the school to $9 million in 2016. The way they do it is, in addition to the $5 million salary for each of the remaining 6 years, Michigan will also loan Harbaugh $4 million in 2016, additional $2 million for the following 5 years to pay the premium on the life insurance policy. The first $2 million loan was made, and then basically what they do is they take that and they just write it off and give it to him at the end of that term.
Absolutely.
As long as he stays with them.
So John, that answers that question.
As long as the insurance policy stays active, he does not. Right here, Harbaugh does not need to repay the loan until he dies, obviously. So.
And the school doesn't care about the loan because the loan is self-sustaining depending on what year it's at. Like Craig could tell you. I mean, like the school's literally legally and just because of uninterrupted compound interest, they're printing money. So like the loan is already taken care of because the amount they're making is supporting the loan that they're giving. So they're just expiring the loan for Jim if he spends, if he stays through his contract, which is what they want. They want to keep him there. Stickiness. Man, it's so cool.
So cool.
I put another one that I found that has a really good breakdown of all the benefits of like why. It's from 2020 though. And they're calling it split dollar life insurance because they're splitting it with the team or whatever and him.
Exactly.
Yeah, split dollar arrangements. I mean, there's key man, there's split dollar, there's all sorts of COLI or corporate uses. Every one of them are very advantageous, but they're just used for different things.
Mm-hmm. So this is an interesting question, kind of on the same note. Nolan says, since I'm older than dirt, could I put together a life insurance benefit for a friend's company for, say, 10 employees where he's the owner of the policies to get money of my money out?
Nolan has a pretty unique scenario, right, where he's getting a pretty large sum of money every year from annuities, and he doesn't even really need that money. So when we talked earlier today, it was really about opening policies on his son, who's around my age. He's around going to be 50, right? And then his son's wife, and then his grandsons. right? And he has trust structures, he has complex trust structure. He has a lot of really good parts going on. And so this is just, he actually, Chris, this is pretty awesome. Nolan actually developed and built a brokerage, a insurance company that he sold in 2007 that was the third largest in Texas with 4,300 employees.
Oh
and
my
sold to Brown and Brown. So this is a man who knows a thing about a thing or two. So.
Oh, that's fantastic. Can we go back to the original question now that I meant more of my money out? So let me just see the original question.
Yeah, it gives you the context of what helps you.
Yeah, so here's the only thing, Nolan, that would have to happen, and I don't have all the details, so just take this at surface level, and we'd have to dive a little deeper. The biggest issue is, Nolan, you yourself, the owner or future owner, does not have an insurable interest in those 10 employees for your friend's company. Now, your friend does. So what you could do, and I've seen this done, actually, we've done this. I wish Hannah was on. You and your friend could structure an arrangement that you're going to fund these policies, but your friend is going to basically facilitate it to get started on these employees. Now, the employees would have to be executives, quote unquote. So they'd all have to get promoted to a vice president or some form of an executive for your friend to have an insurable interest. But then once the policies go in force, the owner would be the company or the owner would be your friend. It could be either one. Okay. When the policies go into force, what would happen is through this legal agreement between Nolan and his friend or his friend's company, it would state that once they're in force for 30 days, his friend is going to give Nolan the ability to become owner. Then Nolan at that time becomes the owner of the policies. And at that time in the agreement, it states that Nolan then takes over and makes the premium deposits. So prior, the thing that keeps Nolan safe is in the agreement, it says if Nolan doesn't become the owner, Nolan isn't going to pay the premiums. So when Nolan's the owner on these 10 employees, like Nolan controls all of the money in the policies. The only thing Nolan and your friend's company would have to do is give these employees some insurable interest, which typically, if you look at banks or anyone else that does it, it's just a fully paid up life insurance policy while those employees are at that company. And it could be 50 to 100 grand, whatever you decide. And you just do a legal agreement. Matter of fact, most of the insurance companies have sample documents that you can just take to your attorney and have them draft right off of the sample document created by the insurance company. We can get those for you. It would certainly work. There just have to be trust between you and your friend and a legal agreement between you and your friend to protect you, Nolan, so that you're not funding these policies and then your friend decides you're not that good of a friend and says, hey, Nolan, I'm just going to keep these policies, which I guess at the end of the day, you could just stop funding them and that would screw them. So either way, I said too much.
No, I think you said just enough. I mean, Nolan's that kind of expansive thinker, right? We spent an hour earlier and went from learning about it to talking about his policy on his son, on his son's wife, right, on his grandchildren, and just how that would look over the years.
That'd be one I'd almost like to go to the whiteboard, do a Zoom, and just draw it out. Because, like, in my mind, I have all that, but I'm sure Nolan's listening, and it maybe just gets a little bit convoluted. But just doing like a timeline of how that would look and like what pieces would go in there. There's only a couple moving pieces, and most of them are just temporary documents.
Okay, we're almost at time, so we'll just hit this last one quickly.
Oh my gosh.
Ghost says, if you are starting off knowing that this is just a starter policy, is it smarter to set up a higher PUA, like a 90-10, or go with the classic 60-40?
Oh gosh, that could go both ways. I know my first policy was literally mine and Craig's were traditional whole lives, all base. And now those things just print money. So I think it really would come down to, if it's your starter policy, we'd need to understand what is the purpose of the policy being set up. Like, are we paying off debt? Are we doing something that requires higher early cash value? Then yes, design your starter policy to have higher early cash value. But if it's not, if it's really just to kind of get your foot in the door, get things started, then I always say just do the classic, the 60-40, because that one's going to give you the best bang for your buck in the long run. And I have 60-40s and I love them and they work very well.
Cool. I guess we'll hit this last one real fast too. Leo says, can this work outside of the USA?
Chris has a video for it.
I got a video for that, outside the USA. Yeah, it's just type in my YouTube. You got to go to my YouTube channel, which I think Leah's already on it. And you just type in IBC outside North America. and it'll show you how this can work. But if it's in Canada, it works almost identical to how it does here in the States, with the exception. It's so funny. Like when I stepped away, this is kind of ironic, and I got to just do this. When I stepped away, I sold a book. Okay, you know, we got a bunch of stuff here that we're just putting on Facebook Marketplace, and the guy paid me in Canadian money. So this waterproof money that, you know, whatever. I didn't care because it's just a bookshelf that's been sitting here. But in Canada, it works. The only difference is the tax advantages we have here with the internal cash value growing tax-free does not exist in Canada. But if you're outside of US or Canada, North America, then go to that video.
And you can also go to the Money Multiplier website, go to resources, read the latest blog, because it's literally putting into words Chris's video, because that was the topic this month. So you can go read it with all the numbers and things, but it's basically talking about that same concept.
I did not know that. I feel bad. There's so many more questions.
No, just one, Rick. Just Rick's. There's a lot of comments, but just Rick popped in.
We go
So
over
Rick,
time, 1 minute for Rick. Rick's a loyal follower. What do you think about an all-in-one loan the way the housing market is today? I think if used properly, an all-in-one is no different than a regular. But it's funny, Rick. Shauna, when do we have Aaron coming on? Chapman. Rick, write this date down.
was it like next week?
August 23rd, 2 weeks from today.
2 weeks from today, Rick, make sure you're on Wealth Webinar, because that's exactly what we're doing. We're literally breaking down. I've got a guy, he's amazing. He's a lot like me. Like if you don't take guys serious that wear baseball hats, you're not going to take him serious. But he's multi-millionaire, runs one of the biggest companies in what he does, and where he's talking all about all-in-ones versus traditional financing and traditional mortgages, but he breaks it down by the math. So Rick, it really comes down to how you're going to use the all-in-one or how you're going to use a cash out refi. But I think you owe it to yourself to come to that webinar and just listen to him. He's got an app, a freaking awesome app. I'll give you the app. Anybody that wants it right now, it's kind of funny. It's QJO. QJO is the name of it, and it's a calculator. That's all it is. Quit. What does it stand? What did I say it stood for, Shauna? Quit
J
jerk
off, I think.
Yeah, he's kind of a jokester, but QJO, and it'll give you calculators, and he's going to be teaching you how to use these calculators. But this is the first time I've ever seen calculators that will do what these do. And the other thing you're going to love about him is he lives and dies, and he lives and breathes IBC. So everything he talks about includes IBC, and it's the math, but he's in the mortgage business. So that would be the best way I could answer that question, because it'll be epic that you attend that.
Yeah, Aaron Chapman. I used to watch Gas Monkey Garage, so I thought it was Aaron Kaufman. That's a bearded man on the Gas Monkey Garage.
Kind of looks like
I was thinking it's like Aaron Cofer and Aaron Chapman.
it looks like he just like came in from chopping wood, but like don't let the look fool you. Believe me, guy's brilliant.
Okay.
Sorry, he's asking about the app. Q. So Q is in Queen, J is in Jake, and then O is in OJ.
J-O-O-J.
I love OJ. Orange juice, not OJ.
Juice of the oranges.
Awesome. Well, we got them all, I think. Or is John got one here?
Yeah, John, you can just email. If you've been working with a mentor, you can just reach out to them. And like Chris said, they'll get to the right place.
Or John, if you don't have a mentor you're already working with, pick one, or just email Steven and he'll pick one for you if you kind of just like somebody else to do it for you. So it's Snaggy, SNAGY @chrisnoggle.com.
I always think of the Flintstones when I hear his name. I don't know about anybody else, but yeah.
All right, guys.
So, this was a really, really, really good Ask Me Anything. So thank you all for your just freaking awesome questions and your awesome attendance. We had over 90 people on today. So we appreciate all of you. We appreciate all of your time. And thanks for joining us for another Ask Me Anything happy hour. Only sad part about it was I think I was the only one that showed up for happy hour. Everybody else, like Steven, what is that shirt? I'm sorry. What is that? Where do people get that?
You like that, huh? Yeah. Look at that one, baby. I got all the gear.
Shameless plug. I got to do it now. Folks,
ChrisNoggle.com.
chrisnoggle.com, go to the shop section or just scroll down to the marketplace. We are creating so many new designs. And the funny thing is we're not going to tell anyone about them. It's only going to kind of be the secret stash that we're creating kind of for ourselves. I don't mean to selfishly say it, but there's going to be shirts that are going to be made that might only be on the site for 30 days because they're a bit edgy. And then we're going to discontinue them after 30 days, but we're going to have them. And I hope some of you do. So check out chrisnoggle.com, go to the shop, get yourself some swag, and we can't wait to see you on the next one. We'll see you next time.